Hey, want to earn up to 6.2% dividends from some of the biggest Hong Kong companies, without opening a foreign brokerage, without currency conversion, and all through the Singapore Exchange in good old SGD? Yes, I'm talking about collecting passive income from giants like HSBC, Bank of China, and Ping An Insurance, straight into your CDP and your bank account. Today, I'm going to show you how to do it using Singapore Depository Receipts, or SDRs, and why these three dividend beasts could help you become cash flow rich, not just asset rich. Stay till the end because I'll break down the pros, the cons, and why holding these long-term could be your smartest move this year. And hey, if you find this useful, smash that like button, subscribe to WealthForYou, and turn on the bell so you never miss a simple, smart way to grow your money. Disclaimer: this video is for educational purposes only and not financial advice. Please do your own research or speak to a licensed financial advisor before investing. Chapter 1. What is an SDR? So what is an SDR? An SDR is like a bridge. It represents a foreign stock, but it's traded locally on the Singapore Exchange in good old SGD. Want a piece of HSBC, Bank of China, or Ping An Insurance? With SDRs, you can own part of these massive companies without flying to Hong Kong or setting up a foreign account. It's like ordering dim sum from your local kopitiam, international flavor, local convenience. Chapter 2. Benefits of SDRs. Let's talk why investors love SDRs. 1. Lower investment barrier. Let's take BYD as an example. Right now, its H shares on the Hong Kong Exchange are trading at around HKD 404, which is about SGD 68.80 per share after conversion. But because Hong Kong stocks trade in board lots of 500 shares, you'd need close to SGD 34,400 just to get started. Wow, must skip bubble tea for the whole year. But with the BYD SDR on SGX, each H share is split into 10 SDRs, and SGX only requires a board lot of 100 SDR units. That's about SGD 686 minimum to get started. Much more manageable, and still the same underlying company. SDRs give you bite-sized access to blue-chip foreign stocks, so you can build a diversified portfolio without over-concentrating all your money into just one counter. Start small, spread out your risk, and grow steadily. 2. Everything in SGD. Forget the headache of currency conversions. With SDRs, everything, your trades, your dividends, and your portfolio value, is in Singapore dollars. Easy to track, no hidden FX fees, and your money stays in familiar territory. 3. CDP custody support. Using a broker that supports CDP? That means your SDRs are held safely under your own name, not bundled up in a nominee account with the broker. That's more control, more transparency, and less stress if anything ever happens to your broker. 4. Lower trading costs. Trading on SGX usually comes with lower brokerage fees, no foreign exchange costs, and no overseas custody fees. Some brokers even offer free SGX trades a few times a month, so you can invest regularly without getting eaten up by fees. More savings equals more to invest. 5. No capital gains tax. In Singapore, there's no tax on capital gains. If your SDR goes up in value and you sell, your profits are 100% yours. But take note, dividend taxes still apply depending on the country. For example, Thailand takes 10%, but Hong Kong doesn't tax dividends at all. Nice, right? 6. Longer trading hours. SGX is open from 9 a.m. to 5 p.m., while the Hong Kong market closes an hour earlier at 4 p.m. And because our public holidays aren't always the same, sometimes you get to trade ahead of the Hong Kong market, especially after big news events. That's a small edge right there for SGX investors. Chapter 3. The negatives. Not everything is sunshine and copy. Let's talk downsides. 1. Liquidity can be low. Because SDRs are still pretty new, some of them don't trade in huge volumes. That means the bid-ask spread might be wider. You may pay a bit more when buying and get a bit less when selling. But if you're a long-term dividend investor, this really isn't a big issue. You're not flipping stocks every week. You're buying to collect income over time. So as long as you're not planning to trade in and out, the low liquidity doesn't affect you much. You're in it for the steady copy money, not short-term gains. 2. The 1% dividend fee. Yes, the SDR issuer may take up to 1% from your dividends as a fee. But honestly, that's like giving away a small crumb while still keeping the whole pie. Let's say you invest in HSBC SDRs, which pay around 5 to 6% dividend yield. Even after the 1% fee, your net yield barely drops. It's still very solid income. For example, if you were supposed to get SGD 68 in dividends, you'd only be charged about 68 cents in fees. You still walk away with SGD 67.32. Not bad at all. And if you're holding growth stocks like Tencent that don't pay dividends at all, then this 1% fee is basically zero, because no dividend equals no fee. The bottom line? If you're investing for dividends, the 1% fee is tiny compared to what you're getting back. And if you're in it for growth, you won't feel it at all. 3. No voting rights. You can't vote at AGMs. But honestly, most of us are here for the dividends, not to raise our hand in shareholder meetings, right? Chapter 4. The Dividend Stars. Now, let's shine the spotlight on 3 of the best SDRs for dividend income. And more importantly, companies that have consistently delivered those dividends year after year. HSBC, SGX, HSHD. A global banking giant with a strong presence across Asia and Europe, focused on expanding its wealth management business and improving cost efficiency with AI. Dividend yield? Around 5 to 6%. And here's the important part. HSBC has been consistently paying dividends for over 10 years, even during tough periods like COVID. That kind of consistency isn't magic. It's backed by real profits and real cash flow. Dividends don't come from creative accounting. You need actual cash in the bank to pay shareholders. Bank of China, SGX HBND, one of China's largest state-owned banks, with strong support from the government. Steady income from loans, deposits, and interest-generating activities. Also offering a dividend yield of around 5 to 6%, regularly paid to investors. Over the past decade, Bank of China has remained reliable and consistent in rewarding shareholders, even through economic cycles and policy shifts. Again, only financially healthy companies with solid fundamentals can pull this off. If the business isn't generating real earnings, you simply can't hand out real cash. Ping An Insurance, SGX HPAD, China's top insurance company, now also expanding into elderly healthcare. Tapping into long-term megatrends like an aging population and AI-driven service delivery. Dividend yield around 5.8 to 6.2%, and showing consistent annual payouts. Unlike banks, Ping An gives you exposure to a different sector. More diversification, more balance. And again, they don't just talk about growth. They're actually sharing profits in cash with investors. That's a sign of strength. Bottom line, consistent dividends are no accident. They're the result of years of solid business performance, strong fundamentals, and real profit generation. You can't fake a dividend. It's either cash out or nothing. So if a company has been paying you every year like clockwork, especially during market ups and downs, that's a company worth holding. Chapter 5. Why hold long-term? All 3 companies, HSBC, Bank of China, and Ping An Insurance, are profitable, fundamentally solid, and cash flow machines. If your goal is to build a steady, reliable stream of passive income, then holding these SDRs long-term just makes a lot of sense. Yes, there are a few downsides like lower trading volume or wider spreads. But if you're in it for income, not flipping trades like a day trader, those things start to matter a lot less. And here's another bonus. SDRs are fully convertible. If you ever want to switch to the original Hong Kong listed shares, you can do that through a proper issuance and cancellation process. Just work with your broker to convert your SDRs into the actual shares, or vice versa, depending on where you want to trade. It's flexible, and your investment is backed by real shares, held by a custodian overseas. It's kind of like buying a copy machine that pays you every month. Slow, steady, dependable. And over time, you're not just asset rich, you're cash flow rich, and that's the real win. Final thoughts. So there you go. HSBC, Bank of China, and Ping An Insurance SDRs. 3 solid companies with strong fundamentals, consistent dividends, and now made accessible to you right here on SGX, in Singapore dollars, with just a few $100 to get started. If you're building a dividend income portfolio and want international exposure without the currency stress, high capital, or foreign brokerage drama, these SDRs could be a fantastic foundation. If you found this video helpful, give it a like to help more investors find this info too. Drop a comment and let me know, which SDR are you most excited about? HSBC for the yield, BOC for stability, or Ping An for that sector diversification? And of course, don't forget to subscribe to WealthForYou. We're here to help you grow your money smarter, one bite-sized investment idea at a time. Until next time, stay invested, stay steady, and most importantly, stay cash flow rich.